Oh, you're parting on the wrong side.
Oh shit. Is that better?
Whoa, it's not that heavily. It's more of like
No, it's more like
a quarter part. Oh yeah, oh, there you are. You're getting there now.
yeah. Okay. Now that we're out of makeup. And
Okay,
the accountant's out of the change room.
he hangs up the shirt but doesn't get the shirt in the picture.
Well, that's I got to move my whole desk, which is going to cause.
You can't swear on the YouTubes.
Yeah, no swearing.
You're not allowed to swear on YouTube?
No, they don't like it.
You've got a stand-up desk. Oh,
No, I don't.
Nailed it.
I have a stand-up desk.
Nailed it. Yeah, that's pretty good.
You forget that we got a new bed, so we.
Don't swear. Don't
Shut
swear.
up.
Like the Phil Hartman bit from News Radio.
I have to turn my furnace off again.
Oh, it's perfect now.
I have the dogs. Don't call them.
We won't call the dogs.
Huh?
We won't call the dogs. Now you're swearing.
True.
Jeez, stop giving me such a hard time.
This is all my edit section usually.
Yeah. Well, we're still editing the podcast, right?
Yes.
I hope so.
We're gonna have to edit the YouTube a little bit.
Yeah.
One would think.
Well, one would know, and I know.
There you go.
All right. You know what? The funniest part is, it actually looks like the accountant has done his hair for the show.
I just knocked over my everything. You guys making me move. This is an absolute disaster.
You know what? Total voice for. He's got the face for radio. Hey.
Yeah, absolutely.
I'm having my pre-game beer already.
Is that in addition to your last episode beer?
It was only half a beer last episode. Let's be fair.
Yeah, 500 milliliters.
You guys are killing me right now. Absolutely killing me.
Are you ready?
No. I'm going home. I am home. I don't know.
Yeah, the threat of going home is no longer the option. That's like, damn it, I'm leaving. Oh, I can't leave home either.
Yeah, I can't do anything.
Can't do anything. No.
Can't do anything. All right. Welcome to the Financial Independence Garage, where we share the tools to improve your finances and unfold the roadmap to financial independence. Gentlemen,
good evening.
Hello, Money Mechanic with you again with my good friends.
I am the accountant.
I'm the economist.
And with us today is
a very...
Is that over there? There, Steamworks.
It's Steamworks Brewing. Yeah.
Boys, so, we have big news. Big news on the show.
Big news. Yeah, our first official brewery sponsor.
My camera's not that good, is it? It's Steamworks. And there's the Stanley Park Bridge in beautiful
I have
Vancouver.
Put it right in front of my face.
Yeah, we got a nice Lionsgate lager here.
After all our hard work, our 20 poor episodes, our subsequent 20 awesome episodes, and now we're into season 3 of fantasticness.
There we go.
And now you can see our lovely faces too, because we're on YouTube. No, the big news is that we actually have an official beer sponsor, not just a lovely listener that sent us beers, but an actual brewery that donated some beers to the show. And here we are promoting Steamworks Brewery from Vancouver. And the accountant has a little bit of a history on, a little bit of background on that brewery.
Yeah, so for 25 years, Steamworks Brewing Co. has been at the forefront of craft brewing innovation and taste. Named after the central steam system that powers its Gastown brewhouse and world-famous steam clock in Vancouver, BC, Steamworks proudly brews distinct, delicious, and award-winning craft beers. And it is still brewed using a steam system, which I found quite interesting.
I can see you guys through this lager. We're having the Steamworks Lionsgate lager on the show tonight, and nice and clear. Cheers, gentlemen. Cheers, listeners. Cheers. I know lots of listeners join in with a beer, except for that one tweet that we had that said the guy says he listens in the morning and he can't partake. He's going to need to adjust his schedule.
That or, breakfast beers.
So thanks to Steamworks for sponsoring this episode. That's pretty exciting for us. That's a big... Well, thanks to all the listeners that have been sponsoring too. FI Garage is up and up from here. And we have a pretty interesting topic tonight that I think...
This is tasty. It's tasty.
I do like beer.
Yeah. Yeah, that's nice.
It's a good thing we don't get too deep into tasting notes here because we're like, beer.
Yes,
we could get
delicious.
sidetracked. It's
We
true.
get
Delicious
sidetracked.
beer.
Yeah, we've been told we ramble way too long before we get into the episode, so let's not do that. So tonight's episode is all about tech investing, tech stocks, the big tech boom. 2020 was amazing. We all freaked out a little bit in March. Well, I shouldn't say we all. Some people freaked out.
The media.
The market freaked out. The media
Market
freaked out.
There we go.
And the recovery's been pretty solid for the majority of the sectors.
And fast.
Relatively fast. Yeah, exactly.
Yeah, that was a real quick turnaround.
But most of us, okay, we're talking about financial independence here, and the underlying theme that we hear in, the FI community or the FIRE community is low cost index investing, broad-based global diversification, right? So you're just going to pick up your Canadian allocation, your US allocation, Europe and Asia, and then emerging markets, and you're set. And you set that up from the beginning. You spreadsheet it, you use passive, you do whatever you do to track that, you maintain your balances, and you just set it and forget it and move on. But what happens when we have a year like we just had in 2020, where tech stocks like Tesla, it's the first one that comes to my mind, is just like astronomical, out of the park, makes no sense if you look at it from a technical analysis point of view. And then you've got these actively managed ETF funds. And my favorite one to mention is ARK. And a lot of our listeners have probably heard of that because it's big in the media. It's like they've got 4 or 5, maybe 6. Geez, I didn't do enough research, obviously. But all their funds are like 140% in 2020. And it begs the question, or maybe not the question as much as what I see people doing is jumping into it and going, this is the next big thing. I'm getting into electric cars. I'm getting into the new biotech. I'm getting into 3D printing. I'm getting into tech. Well, what do we think about that? And it's hard to argue with
the late 90s.
Yeah, well, this is the thing, right?
Or the marijuana boom.
Yeah, the marijuana boom. Is this? I don't know if how would I want to frame this episode just yet. I want to have a discussion with it about tech with you guys. And I don't necessarily know whether this is going to be a cautionary tale yet, or it's going to be a rah, maybe I need to allocate some. So let's dive into it, because I don't know what the right answer is. And I bet a lot of our listeners don't either, because I'm sitting there with my index funds going, but am I missing out, right? It's fear of missing out, FOMO. Am I missing out on tech? Do I need to put tech in my portfolio? Accountant, you've done a little bit of digging today. What did you come up with?
Well, I'm just going to answer that question first. I mean, if you have a broad-based total U.S. market fund, there is tech in your portfolio. If you have a broad-based world fund, there is tech in your portfolio. It's whether you want to allocate more to said tech.
Yeah, fair enough, right?
Because I believe Tesla just got added to the S&P 500.
It did
not that long ago.
But you might even have it if you're, you might have it before it got on the S&P 500.
Sure, if you don't have a specific S&P 500 index fund. Yeah, I mean, absolutely. So, I mean, it has, like, I looked at a bunch of, I think it's the Vanguard Total Tech ETF, the iShares Global Tech ETF, and the iShares US Tech ETFs, and they've outperformed in recent years. But
are those Canadian listed ones? I'm just trying to get my head around, because I'm not familiar with all the tech ETFs. I mean, there's thousands ETFs in Canada. You can probably cherry pick the ones you want.
So
are they Canadian listed or US?
These ones were US listed, I believe. It's VGT, IYW, and IXN.
I love that you found different ones that I found.
Well, that's the other thing, right? Is there's tons of these kicking around.
Where do you put your money?
Yeah.
Do you have any of those?
I don't have any of those.
No.
But if you look at it, I mean, for the past 10 years, those I think the worst of those three, the 10-year annualized return was about 18%.
So you're saying we should. Like you're coming out of the gate. You're coming out of the gate going, "Hey, the 10-year performance has been good. Why aren't you doing this?"
It's been great for sure, but I have a hard time. To circle back to Tesla, like, what's it trading at to price to earnings right now?
That doesn't matter.
I know,
doesn't
but it
matter.
does at some
Wait.
point, right? Like, doesn't reality have to set in eventually?
Does it not matter for a trader, or does it not matter for a long-term investor?
I don't know. I don't. It definitely doesn't matter to a trader.
No.
Like
No, trader doesn't care, but that's not what we're talking about.
Well,
Yeah.
okay, but maybe we're talking play. Let's not talk play money here. I think we can get sidetracked if we talk play money, because it's fun to throw. Not that like one Tesla stock is a lot of play money, to put it that way, but maybe I want to put $1,000 into said ETF that's tech. Maybe that's my play money, right? So let's get away from that and look at more of, am I adding this to a long-term part of my core portfolio? Do I want a tech tilt to my index investing? Maybe that's kind of the angle we need to look at. To get a better discussion out of this, because if we go down the road of like trading or what's popular, then that's fine, because I think that's what we run into, is a lot of it is a popularity contest, a lot of it is marketing driven. What's the hottest new thing? That's what drives a lot of the tech sector up, right? Whether it's just because there's so much more accessibility on the internet now than there ever used to be, but I was blown away. We were sharing some information today in prep for this, and I came across Neo.Inc., which I'd never heard of before. And the Economist quickly texts back and he goes, "Oh yeah, that's no big deal." But the quote on this, it says, "It's a futuristic senior stock exchange. It offers added liquidity, which simply isn't available in junior exchanges." And what does that mean to the listener? Well, basically, I kind of just had a quick scroll through here. They're trading like every penny stock in the tech universe. It's insane.
What's below tertiary?
Quaternary?
So it's a
quaternary?
It's a quaternary index, or a quaternary trading stock exchange.
You can get
right?
15 you can get 15-cent stocks on here. I mean, there's some $20 stuff, so maybe they've got earnings, maybe they don't. I think, and accountant, you can probably speak to this better than I can from that point of view, is that I can look on here and I'm just scrolling through and I'm seeing stuff for 6 cents. Halo Labs, that looks like it could be an investment because it might go up 300%. And this is what bugs me. And I got to vent a little bit on this show, because you get these numbers thrown out that it's up 200%, 300%, 400%. When it's a 10-cent stock, it's pretty easy to hit those percentage numbers, but it really means nothing in real life.
Yeah, 100%.
We see
sell, it does. If it's sell, it means you got more dollars.
Fair, but that's trading, isn't it?
Yeah, it is, and speculation.
Yeah.
I mean, I feel like there's a lot of, it's not that I'm not a believer in tech, but I feel like there's a lot of survivorship bias right now from like, oh, well, everybody's talking about Amazon, and if you could have got into Amazon early or Apple early or Google early, but those are 3 of the world's biggest companies now. But you guys forget about the 30,000, maybe 300,000 companies that went bust in the early 2000s when the tech bubble burst and there was all those crazy IPOs going on and all that. And I mean, I just feel that things are getting a little frothy.
AOL, was that ever publicly traded?
I think AOL was publicly traded. Was Ask Jeeves? I feel like Ask Jeeves was.
That's going back there. Ask Jeeves. Are you old enough to remember Ask? I guess you're old enough to remember. Jeeves. I forget. You're old enough to remember all of the internet. So
yeah, I was around for it.
Well, maybe not all of it, but anyway. Yeah, no. I guess for me, let's bring it down to current day. Here we are, beginning of 2021. I wanted to talk today about the ARK ETF funds, because they are super popular in the media, and I've seen multiple social media comments saying, "I'm 100%, I'm all in on ARK. I'm totally bullish on ARK. I'm getting in. I'm all in. I'm putting my TFSA in there. I believe in it." And I am fearful, and it reminds me of that specific saying, is be fearful when others are greedy. And greedy when others are fearful. If you were saying this to me in March last year, I missed that boat. right? And maybe you didn't. And to those people that got 146% returns, because that's what last year's like the ARK K fund was, that's fantastic and good for you. Nothing wrong with that. You placed a solid bet on that. You've made a speculative investment and you made money. Same if you got into Tesla last year. Like nothing wrong with that. I don't think we're here to knock that at all.
I don't think that can be the core of your portfolio.
No, well, okay, that's one thing. But I am also thinking that if I'm looking at a really inflated valuation, for an ETF that holds a lot of underlying businesses that have yet to prove themselves profitable in a traditional model. And I think that's where this gets into nuanced discussion, is the traditional model of what's a profitable business and what isn't. And is it a disruptive technology? Yes, it is. Is that what their core, what they're actively trading and actively looking for, is disruptive technologies? Yes, I understand that. That's good. But if we see like astronomical growth, I think I did it the right way this time, right?
Yeah, you did.
Because I have to kind of do it backwards.
Yeah, there you go.
Yeah, pretty good. So it's like astronomical growth. It just makes me personally, as a long-term investor, go, what are my expected returns from there going forward? And this is why we're talking about tech today on this show in 2021.
Right. And I haven't looked at the ARK funds personally, but like, what's your price earnings ratio on one of those?
You're not allowed to check that.
You're not
right.
What do you mean you're not allowed?
It's irrelevant.
They don't advertise it?
It's irrelevant. It's hundreds. It's hundreds. It's like the pot stocks. 2,000 price to earnings. You can't calculate. How do you calculate price to earnings when there's no earnings?
Well, in an ETF, there must be earnings, but it's just minuscule, is what you're saying.
Yeah,
I guess.
Well,
I guess.
And you look at some of these tech stocks that, maybe they will be disruptive, maybe they won't. But even if you take that they will be disruptive and you look at them, like Tesla, how many cars do they have to sell to actually earn the valuation they're currently trading at?
Well,
many cars.
Yeah.
Right.
So sorry to jump in, but I heard a quote as well that and I'm not saying this is true, but it's like, if Tesla's valuation is, let's just call it 500 for a number, and Nissan or General Motors, or pick another car maker, is 25, this is the price to earnings ratio. If one ratio is 25 and the other is 500, what's more likely? The one's going to go up or the one's going to go down? Like, they kind of have to somehow find the middle ground eventually.
And everybody else is entering the electric car market, right? Like everybody else. So are zero of them going to compete with Tesla? That seems unlikely, that zero of the car manufacturers plus other tech companies who are looking at making cars, none of them are going to compete with Tesla? I don't think so.
Yeah. It just seems very, and I don't want to just be picking on Tesla. It's the most in the news, talked about.
It's the easiest one.
It's the easiest thing.
Yeah.
Is this investment advice or is this entertainment purposes?
Oh, absolutely entertainment purposes.
Since we started being on video, clearly this is only entertainment value.
Speaking, this beer is delicious.
I'm glad there's at least 2 in my house.
It doesn't taste like a macro brute lager.
So we got chirped for drinking Lucky, and apparently a 12-pack of these is $17.99 at the liquor store right now. So very comparable price, and this is definitely a step up. Yeah.
Yeah.
You could slip this
more flavor.
You could slip this into the fridge when you're visiting your parents' house, and your dad would drink it and not know the difference. And you could drink it and go, it tastes better than his, not going to name a name, that he always has in the fridge. How's that?
Yeah, that's good.
That's my unscripted promo right there. At least it's not free advertising on this show, boys.
That's right. Cheers to Steamworks.
Mm-hmm.
Cheers.
All right, so I found a good article along the same line of what I'm trying to get at here.
Wait, before you leave ARK.
Why? Go ahead.
No,
the article's about ARK.
The other thing about
I'm not leaving ARK yet, believe me.
Okay, but it's actively managed. Why do you want an actively managed fund?
Because you have to be. You have to be actively managed, because you're cherry picking, or you're if you listen to some of the interviews that Kathy Wood. Geez, I hope I got that right. I'm sure I did. I read
Yeah.
enough about it
So
today.
wait,
Let me
the
finish.
ARC lady is going to tell you that
The
you
ARC
have
lady.
to pick. You can't rely on an index.
Yes,
That's correct.
that's yes, yes,
Ghost
yes,
surprise.
yes. I better have the name right. Geez, I'm scrolling through trying to find it now. I'm pretty sure it is, but hey, I got it right. Woo, 2 points. No, the point is it has to be actively managed because there is so much out there, like a ton of new tech, new startups all the time. So the skill of the manager is to pick those ones that are ready for prime time, those ones that are ready to go big. You add them to the fund. That's what makes it successful. You have to be actively managed, which I think fundamentally we kind of disagree with. I'd rather hold the NASDAQ personally and be okay with the growth of that, even though like the track record for the last 5 years, well, let's not even take 5 years because they were fairly comparable in 2019. But in 2020, I've got the S&P 500 total return, and then ARC is like 600%. And then QQQ, have you guys heard of QQQ? It's hard to say. QQQ. It's basically it's the tech index one that you can pick, and it's not a terrible one for Canadians to pick if they want to get into get a little tech heavy with their core holdings. But I like QQQ because it is more of an index, and it basically holds the whole NASDAQ, right?
So you can have an index.
Right? But
Yes,
the point here is that QQQ, although is really good, its returns. We'll put this chart in the show notes so our listeners and viewers can look at it. And this is where the economist is going to get really good at YouTube, and you'll pop this chart up while we're talking about it, right?
Yeah, right.
But anyway, we're talking.
You can share your screen.
Oh, I guess I could. Oh my goodness, that would get complicated. These episodes are going to go sideways.
Don't overcomplicate.
That would be how you would do it, though. You wouldn't rely on me.
No, you wouldn't.
There's some people that are really good at YouTube, and we are not them.
No,
absolutely not.
But the point is, with this time frame, so okay, let's call it 2015 to the end of 2020 because that's the graph I'm looking at here. QQQ is 232%, which is fantastic. ARC is 615, but they were basically matched in March this year, so it's outperformed like astronomically in 1 year. How does that not give you a red flag of like, okay?
Well, you think they ran good?
Well, this article. Okay, so this article is called, and it's by Ben Carlson. It was written in late 2020, so it's current, which was important. I think it's important, right? It has to be current right now for this. It's a short history of chasing the best performing funds, and this is why part of this episode for me is a cautionary tale. I think it's a cautionary tale, right? Because if you're just chasing the latest, greatest, best performing funds, you probably should take into account that you have lower expected returns and or the possibility that you're buying high and you may end up selling low. Because if you're looking at this and going, I need to get into ARC funds, and I'm not here to pick on ARC funds, okay? It just happens to be the one that's the easiest, like Tesla, to talk about. It's like, I got to get in there. I'm putting my TFSA in this. There's going to be another 146% growth this year. And you're emotional about it. You jump into it. You put $6,000 into it. And in April, it's flat. It's a dud. It's down 10%. Tech's struggling a little bit this year. The economy's finally having to get burped for all the things that have happened in 2020. And you go, yeah, okay, you know what? I better just go back to index investing, and you sell. It becomes that psychological part of this equation. And this article is good about bringing that up, is that if you go into these investments, or if you look at the huge increase in tech and go, I want to be in that, because we all do. We all wanted to get in that, but we didn't, or some of us didn't. But if you get in now, it's possible that you're getting in for the wrong reasons, and you may succumb to your psychology of selling it when it underperforms.
But here's the thing about people, because I've heard this a lot lately. Oh, maybe this whole indexing thing, because everything blew up in the second half of 2020. Maybe I shouldn't just be indexed, but if you're indexed, you're in whatever the hot thing is.
Agreed.
If you have a total world diversified indexed portfolio, whatever the hot thing is, you own a piece of it. Yeah. And you also own a piece of whatever is a dog right now and has a really great chance of becoming the next thing.
And also the stalwarts, right? The companies
What's
that keep trudging along and making.
what about those utilities that just keep raising dividends and just keep paying me money and are just
those
steady? Like of course it's alluring to chase the hot thing or what's done really well for the past 10, 20 years. But I mean, there's so much historical evidence to say if you're going to be somebody who just indexes and follows the market and has a well-diversified portfolio, you hold that for 30 or 40 years, you're probably going to beat everybody else.
Okay. I agree with you. Unfortunately, I agree with you. It doesn't make for fun episodes when I always agree with you. But I was going to add to that and saying, if I'm a smart, FI focused investor.
So we're not talking about you.
He said it's a hypothetical.
Oh, okay.
Oh, thank you. Well, I think we're going to get to where you want to poke fun at me anyway, is if I'm going to experiment outside my core portfolio. Okay. So let's just say that
right.
You feel like tech's something that you're missing out on. You're not getting enough of it, even though, like when I was holding TD mutual funds, they were great. I mean, they've come down in fees and they've got a NASDAQ mutual fund that I could use in my TD brokerage, and it cost me nothing to buy it, nothing to sell it. And the fees were, I think they're down to 0.3 something now. I'm not quoting it, but that fund did great. You can just hold that as a Canadian and it's worry free. It's indexed. My point is that if you're going to jump into an actively managed fund that has had great returns, are you going to do it with a huge amount of money? Like maybe you put in 1,000, maybe you put in 6,000, maybe you put in, it's a nominal amount and you're like, oh my God, I got 146% returns. Well, that's excellent on a small amount of money. Just you see where I'm going with this? Like your core portfolio or your $1 million retirement portfolio needs to be protected safely growing at index rates. Sure, you put 10K in tech and you made 14 and you're like, woo, this is fantastic, right? Or 24, whatever the number works out to. I'm not the math guy.
So
right. But I'll also say, I mean, unless this is something you're interested in, you want to do, if you have, let's say you have a $500,000 portfolio and you put 10 grand into something that outperforms and gives you a 50% return, at the end of the day, is that extra 5 grand really making a big picture difference?
That's my point. That's exactly my point.
And you don't want to risk everything in one sector.
No.
Or else you end up, down like you were with marijuana. When you bought medium,
I was not down.
I
didn't buy
marijuana. The royal you.
I didn't buy marijuana when every news channel was pumping marijuana because it was too late. It was too late to get in. And personal opinion only, I feel like some of these tech funds, it's too late right now. I could be totally wrong, and that's fine. I'm okay with being wrong, right?
The one thing I think about tech is it's happening so quick. Like new technologies coming online so quick, the possibility exists that you're always going to get big returns if you're on the cutting edge. But how do we know that one person who's on the cutting edge today is going to be able to keep up and know what the cutting edge is tomorrow? So if you're in an actively managed fund,
AI. Don't laugh though. No, I'm answering his question with algorithms. Algorithms are what's keeping up.
Right. So that could be, but somebody has to write the algorithm.
Totally. Yeah.
Right. So
the algorithm can
be one that's written for today, is it learning for tomorrow? I don't know.
AI.
Yeah. No, I get that. It's possible. It's totally possible, but it's just at this point it's unlikely that
the other thing with a lot of
one thing that's going to perform the best today will also perform the best in 5 years. That's unlikely.
Yes.
And that's what we've been historically taught.
Right.
The other factor here is that a lot of these companies, a lot of these tech startups, I mean, I've seen this firsthand because I had a major company IPO that I had been a part of, not owner or anything, but just assisting with. The money on IPOs, like you go on IPO day to buy that stock, the people who hit a home run on that stock owned it well before it IPO'd. That's not the day that you made your killing. That's the day that everybody that was in on the ground floor made their killing.
Yeah, totally. So
you get something that's at a huge price to earnings and the market wants it and it IPOs. A lot of times those shares just stagnate for the next 5-10 years because they got frothy valuations, they took it to market, and a lot of people are actually just cashing out. That was their exit strategy for a lot of these startups was we built a business, we've got a good technology, I'm washing my hands of this. I got 100,000 shares when we first started the company. We IPO'd at $20. I got my $2 million and walked away.
So I totally agree with you. And I guess my question is, these actively managed ETFs like ARK, are they sort of a hedge fund where they get into private companies? Because that's an advantage over the index tech ETF.
Yeah, I don't know enough
it's
about
true.
it. I don't know enough about it. I'm gonna have to plead ignorance on that. I did enough research to be able to banter with you boys, but not speak intelligently. Most of our listeners know that by now.
Fair enough.
Yeah, we're here to banter, not for intelligent talk.
Yeah. No, I think you make a good point there, economist, is that do you have an advantage having the private into that? I don't know. I think that adds a huge level of risk into that actively managed fund as well, right?
But also, aren't most of the ARK funds, like, because I've seen the person who runs ARK funds, whatever her name was,
Kathy Wood,
she's always just pumping Tesla. And I think a lot of the returns from ARK is just Tesla.
10%, 10% of their holding is Tesla.
Okay.
And I did enjoy a few YouTubes today watching her just go like she needed pom-poms. Like TELUS Tesla.
No, that's wrong. Not even close.
Turns out the mechanic is not winning his cheerleader edition.
I don't think he's winning a spelling bee either.
TESLA.
He got it.
Third time's a charm.
No, she's definitely been very pro Tesla. And, fair play. She was right in 2020, right? Like she was predicting before the crash and correction. She was bullish before, and she's maintained her position on that. And I respect somebody that'll maintain their position on their beliefs of what the stock's going to be, right? Do I necessarily agree on the fundamentals? Maybe not. But, she stood by it and she believes in it. And because she's one of the, the think tank behind that fund, she sticks with it. And that has been a huge part of its success. And to be perfectly honest with you boys, which you're going to hate, is I was part of the 2020 stock picking contest.
Right.
And the funny part was the stock picking contest started off in the beginning of 2020, as it always does, me 2 weeks late and everybody getting the first 2 weeks of gains. And you guys just trying to index all year. And basically we all stopped trading in March. Like the 20 of us in the contest, which is a bunch of other bloggers in Canada and the US, we stopped trading because we're like, what just happened? We have no idea what to do. No idea. So everybody just stayed with their holdings for basically the whole year because nobody had a clue. And on an absolute lark, I picked Tesla last January because I was like, I like to pick things in the stock picking contest that I'm probably not going to own in real life because I don't know how to value them. I can't afford them or whatever. And so I picked a ton of Tesla stock and I came in third in the stock picking contest, boys, from Tesla. So there you go.
I actually saw that the other day. I saw that post. I was very proud of you.
Yeah. But again, and the top three, it was the three of us that had bought it at the beginning as a bit of a lark because the other guys that bought it too, they're Canadians that are thoughtful about their investing process. They own blue chip dividend stocks. They own index ETFs. It's the kind of stock that we look at and go, yeah, if I had an extra $100,000 that I didn't know what to do with, then I might, buy into it. And that's what we did. We're like, we got a free $1 million for this fun stock picking contest. So let's throw it in there and see what happens. And hey, lo and behold, there you go. That's part of the book I'm reading, Thinking in Bets. It's it's a bias, right? Success bias is not because you made a good decision. It's because of the other variables in the outcome.
Yeah.
That particular time we didn't talk, not because we were waiting to say more, but because we were waiting to cut the recording so we can restart the new one.
Let's do that. Let's get a beer.
I've got one.